Hello, FastGraph subscribers. It's Chuck Carnevale, co-founder. And I've been talking to subscribers here recently, and of course we all know that we're going through some really crazy times today. And I've actually had some subscribers say to me that, FastGraphs don't seem to be working anymore. Stocks are trading way above the orange line. Some are trading way below the orange line. Some stocks have been doing this for years. And, they're just saying the FastGraphs aren't as relevant as they used to be. Well, from my perspective, nothing could be farther from the truth, because one of the great foundational values of the FastGraph research tool is that it really shows you and reveals the amount of risk you're taking. When you see massive overvaluation, even massive overvaluation that has gone on for a long period of time, you need to be able to just simply recognize that in the short run, sentiment will often rule. The market can do crazy things. Stocks can rise and keep rising well above what fundamental values support, and do that for a pretty extended period of time. During the irrational exuberant period, that led to the lost decade, we had stocks rising for years, 3, 4, 5 years. The tech bubble, which was absolutely insidious during that time frame, where you had tech stocks rising to just astronomical valuations. I'll show you an example here in a little bit. These things were crazy, but eventually fundamentals ruled and the stock prices ultimately reverted to the mean. So in my perspective, when you're dealing in a crazy market like this, FastGraphs could never be more important than they are to you and for you today. Now let me try to put this into perspective. I think we're dealing with a bifurcated stock market. We have two extremes. We have extreme overvaluation and we have extreme undervaluation thanks to the COVID pandemic. But the point is, if you look at the overall market itself, this is the S&P 500. You can learn an awful lot by studying the history here. This is just coming out of the irrational exuberant period, which really ended with the recession of 2001. And stock prices fell dramatically, and you can see that the S&P 500's earnings also fell by 31% a year. But then following that, we had S&P earnings that were very, very good coming up to really the Great Recession, which started in 2008. We had one flat year in 2007, and stock prices tracked that. But notice that the prices stayed within this, I'll call it valuation range or corridor of between 15 and 17 times earnings. Then, of course, the Great Recession came. We know what happened there. The earnings fell. The stock market itself fell by over 40%. Even the dividend of the S&P 500 was cut. But then as we came out of the Great Recession, as the stock market began to recover, we saw this really excellent period of earnings growth here, and the stock market was fairly valued for several years. Tremendous buying opportunity if you were buying an index fund. And then it got kind of fully valued, and then we had this surge in earnings growth in 2017 and 2018, and of course the market price reacted to that. But then inexplicably, we come into COVID. Now forecasts for earnings were a lot stronger than they actually turned out to be, even for 2019. But then we had this flash crash. The market fell dramatically at first. This is in the spring of 2020, which we're living in now. And yet now, since then, the stock market itself, the S&P 500, has recovered virtually back to its all-time highs, if you will, or certainly close to it, in spite of the fact that we're really expecting a 22% drop in earnings for this fiscal year, which is a calendar fiscal year. But then analysts are expecting a strong market recovery going forward, and so perhaps the market is looking ahead. But the bottom line is, the stock market is significantly overvalued here based on historical norms, as you can see, and that's the overall general market. So we have the COVID pandemic, but on the flip side of that, we also have several stocks that are actually undervalued. But there are certain names, some of the iconic brands like Nike, for example, that we're looking at here. And this is really, to me, Nike is really a conundrum. But the point is that with FastGraphs, you're seeing this. It's vivid evidence clearly illustrating that, Nike, all the way from the prior to the irrational exuberant period, going through the recession of 2000 and the recession of 2008-9, Nike actually did quite well. Earnings were good. The dividend grew, during this period of time. The stock price held up better than most. And then it, followed the next couple of years. But then we had this very large increase in valuation or separation from valuation. It did result in a pretty significant down year for fiscal year 2000. I guess you'd call that fiscal year 2016-17. Keep in mind, this company has a May fiscal year end. And then since then, we've had this huge rally. The flash crash that happened to the market also happened to Nike initially with COVID, earnings have fallen. But here's the conundrum to me. Really, we've had no earnings results for the last 3 years, and yet we have this inexplicable surge in stock price for Nike. And it's a retailer, essentially, or at least it depends on retailers. We can see how important retail was to Nike with the closing of all these retail stores and the malls and so on. Nike ended up suffering a significant drop in earnings for fiscal 2020, which ended in May. It was a 36% drop. Now, analysts expect 2 very strong years following this for this fiscal year and next fiscal year, but the stock price is trading at these nosebleed valuations. It really doesn't make any sense. But that happens in the stock market. It's always happened in the stock market. In the short run, sentiment rules, but in the long run, fundamentals rule. But let's look at flip side here. Let's look at a company like AmerisourceBergen, a top healthcare distributor, if you will. Look at the relationship between earnings and price that you see with this company. Stock price has tracked earnings beautifully, and the orange line here is a 15 PE ratio, and the normal PE is about a 16.7 times earnings. And we had, most of the time the stock trades within those parameters, and when it gets above that, that turns out to be I'll call it a less than optimum time to be investing. And when the stock price gets below the orange earnings line, that becomes an optimum time to be investing. And we see that over and over again on this graph. We had this really surge in earnings, 26% for fiscal 2014. This is a September fiscal year. And then 25% for fiscal 2015. And that created a lot of enthusiasm for the stock. But then we had a little bit of a flattening. It still had double-digit growth and then only single-digit growth. And the stock price fell precipitously during this period of time. And then the stock's been kind of languishing ever since, but it trades at just under 14 times earnings, gives us a very attractive earnings yield of 7.25% and a dividend yield of 1.86. It's an A- rated company. So here we have a situation, even though the market in general is overvalued, it's a market of stocks, not a stock market, as I always say. We have this very undervalued stock, and now it's got a 14% historical growth rate. That's very significantly important to what I'm about to show you, because I can then flip over to a more technology, IT consulting oriented company, Accenture, another blue chip, A+ rated, well-known name. The earnings yield here is only 3.4%. But again, you see how the stock price behaved what I'll call moderately rationally for all these years. 2000 recession, got overvalued, corrected, reverted to the mean. Anytime we saw overvaluation, reverted to the mean. But now we've got this dramatic increase. But here's the rub. The stock has grown at 12.9%. We saw AmerisourceBergen growing at over 14%. We have, a lower dividend yield here, an earnings yield of only 3.4%, and yet you have this, this dichotomy, if you will, of the valuation between this great company and this great company. But FastGraphs is revealing that. It's showing you that there is this conundrum here. You have one stock that's clearly trading at a historic high valuation versus, a stock that's trading at a normal valuation. And let's look at Walmart. Let's look at Walmart, which is obviously the 800-pound gorilla in retail. And it's got so many stories to tell when you look at its history here. First of all, retail is generally an out-of-favor sector, and yet you've got Walmart here trading today at these very, very high valuations, and we actually have some rather anemic performance. But, let's not forget that all businesses generate value for their stakeholders or shareholders based on the amount of money that they generate for those stakeholders. And so we've actually had very, very poor operating performance for Walmart. Earnings growth since 2013, where earnings grew at 12% from the previous year. It only grew by 2% in 2014, minus 1% in 2015. This is the January fiscal year, minus 9% in 2016, minus 6%, followed by 2%. Now we had this little surge in earnings for 2019, and then 0% growth in 2020 essentially, and then expectations for 2% growth next year and 8%, yet the stock price has surged to the upside. And yet you can look at other retailers, names like CVS, Walgreens, that are of course in a different industry that are, trading at significantly different. Even if we took a look at Target, which I would say would be Walmart's main competitor, notwithstanding Amazon. If we took a look at Target here, we would see that Target is certainly trading at a much more rational valuation, but even Target now has become overvalued in this crazy market. And again, you can see where Target traded much more rationally. But let's go back to this Walmart example, because I wasn't really finished with the story. I think it's very important that investors recognize that sentiment rules in the short to intermediate term, and the short term can turn into the intermediate term. But the point is, let's look at Walmart historically. Let's go back in time and look at what the valuation was back in 2000. Today we've got a PE ratio, just to be clear, of just under 26. So, I can find a PE ratio close to that. Here's 27 times earnings. These are in the 20 and 30 times earnings range. And just, if you look at it, even though this is a PE of 42, you went through this almost whole decade here where you would have actually lost money owning Walmart, even though the business did great and the dividend increased every year, because it was highly valued, and it stayed highly valued for years. But on the other flip side, it didn't go anywhere. Then once it got back to fair value, it kind of tracked fair value for a while. And then we've had this really poor operating performance, and yet all of a sudden the stock price has skyrocketed again to these nosebleed valuations. And the point is, there is no fundamental value supporting Walmart here. This is strictly, again, irrational exuberance like we saw in the past. Let's look at another example that's even perhaps more striking. Let's look at perhaps my favorite stock on the planet. Let's look at Microsoft, and we're going to see a very, very similar story here on Microsoft as you did with Walmart. But there's some differences here and some subtleties that I want to point out to you that I think are critically important. If I look at Microsoft today, we've got a PE ratio of just under 35, 34.7, okay, 0.74. If I go back into the rational exuberant period, there's a PE of 47, there's a PE of 40, there's a PE of about 35. That's pretty close to what the PE is now. Now, when the PE of Microsoft was that high, coming, just prior to the recession of 2000, look at the price. The price was $30 a share. You went all the way out to August of 2012 before you saw that price of 30 again, if you will. You had a 1% annualized rate of return from 2000 to 2012. This is more than a lost decade. This is a lost 12 years. But yet, we also saw that Microsoft was trading at very low PEs here, sub 10, 9.98 times earnings, 9.6 times earnings. Today, it trades at 35 times earnings again. Now, the PE ratio has been steadily increasing. This stock has pure momentum. There's no doubt, a question about that. Of course, it's AAA rated, has moderate debt. It has an earnings yield, however, of less than 3%. And I can show you numerous stocks that you can get a dividend yield above 3%. The dividend yield is just over 1%, and that's strictly attributed to the fact that the valuation is so high. But it is what it is. The valuation here is real. Microsoft stock value is trading at this high level, but a rational investor ought to recognize that there's nothing here as good as Microsoft is doing. And look at its growth rate here. It's averaged 10% long term, but if I shorten this to just the last 5, 6, 7 years or so, the growth rate's up to almost 17% a year, 15.8. I can actually even get a little higher, I think, if I go back a year. No, that took it the wrong way. If I shorten it a year, we're up at 17.5% over the last, say, 3 or 4 years. But again, that surge in growth, which is remarkable for a $1.5 trillion market cap company, if you will, it's still, you're looking at forecasting earnings growth here. Analysts are expecting, 13% growth on average over the next 3 years. And if I look out 3 to 5 years, they're expecting it to be about 14.3% growth. Well, there are companies I've already shown you that are growing, that fast or faster that I can buy at a very inexpensive value. The A+ rated large pharmaceutical company, Bristol Myers, would be a case in point. Now let's look at the contrast here. Here we can buy Bristol Myers at 10.67 PE ratio, blended PE ratio of under 11, an earnings yield of 9.37%, and a dividend yield of 3%. The dividend yield on Bristol Myers is higher than the earnings yield on Microsoft. And we've got, again, just like we did with Microsoft, this surge in earnings. So if I shorten this time frame, earnings growth for Bristol Myers has been over 21% a year. If I look at forecast growth, it's for over 14% a year. That's certainly comparable, if not slightly better than what we saw with Microsoft. Yet I can buy this at 10 times earnings or just under 11 times earnings, where I got to pay almost 30 times earnings to buy Microsoft. And let me kind of just end this by making a point here. If I took $1 worth of dividends that I got paid from investment in Bristol Myers out of my left pocket, and I took $1 worth of dividends that I got from Microsoft out of my right pocket, and I bought something in the store for 50 cents and I offered them either one of those dollars, they wouldn't say, oh, well, we'll give you 3 times as much change on your Microsoft dividend dollars than we will your Bristol Myers. The point is, a dollar's a dollar. This growth rate has value. And, if it's going to grow at, 14% going forward, that gives it real value. But, Microsoft's going to get the same growth. It doesn't get 3 times the value, if you follow my drift. Now, the reality of it is, please recognize that fast graphs are probably more relevant today than they've ever been for you. You're really seeing some craziness in the market, and you're seeing it vividly revealed to you. And there's nothing that can protect you better than that from the risks of overpaying for a stock that I've displayed here and discussed in this video. But also, there's nothing that can show you where the opportunities in the marketplaces are, in my humble opinion, better than fast graphs. So use the tool now, rely on it, use it correctly. Go through some of the types of analysis that I've showed you here in this video, because fast graphs have never been more important, in my opinion, to the everyday investor than they are to you right now. And I want to thank you all for being a subscriber. I'm telling you, it's a great tool, and it can really help you make prudent long-term investment decisions, especially in these crazy times. And, I'd like to end by saying, please give me a like and hit the bell so you can subscribe to the YouTube channel to see more videos like this if you haven't already. I want to thank you all for being a subscriber, and I look forward to doing more work like this for you. Thanks for watching the video, and happy investing and profitable investing going forward. Thanks.